Phil Verleger, oil. This is one of the go-to guys just recently with the University of Calgary, and the must-read in the industry, PK Verleger newsletter. Let's talk gasoline first, Phil. You have a brilliant chart. We didn't replicate it, but we got the idea here that we really are finally getting demand destruction in gasoline. Why are we using less gasoline?
Well, there's several reasons, Tom. One, higher prices. Second, the consumer is constrained, as you've been talking about for months, in terms of income. And consumers have been working really hard to get gasoline consumption down so they have more money for other things. Essentially, they've given themselves, in real dollar terms, a $50 billion tax cut. Gasoline consumption should be running almost $300 billion in constant dollar rate. It's running at 246. And according to BEA, and this is down from 2005. So what's happened is, as prices went up, consumers are driving less. They're also moving much more rapidly into these new efficient automobiles. And I guess I got onto this message in late July when President Obama had that meeting with the auto manufacturers, and everybody agreed to go to 52 miles a gallon by 2020. And you looked at the meeting and you said, who's not here? And it was the oil companies who weren't there. Now, can you imagine what would have happened if they had a meeting and said, look, we're going to cut sugar consumption by 50%, by cutting carbonated beverages? Coke and Pepsi would scream. The oil industry said nothing. So essentially, oil is just being squeezed out quietly. It's going away, and thank you very much, nobody's going to buy it. Yesterday, interestingly enough, we saw Sun close their refineries in Philadelphia. They've said, oh, people aren't buying gasoline. There is really strong conservation taking place, and it's showing up.
And you're making clear, Phil, that this is structural. Bring up the note, if you would, from Phil Verleger, and you can see it here as he talks about the bad news is they are aggressively cutting gasoline use. The divergence in July extended a trend that goes back to the middle of the last year. Is this a structural change? Is it a behavioral, societal change, or is this just a cyclical thing, and we'll all be back to driving Hummers here in 2 years?
Now, this is clearly structural, and it's societal. The Hummer's gone, and we're going to be driving much smaller and more efficient vehicles. You already see them. We drove out to Napa over late August, and the cars on the road are much smaller, and people are actually driving slower. I think that the impact of $4 gasoline has been felt everywhere, and consumers are doing everything possible to move away from it. As soon as they have natural gas available in a widespread basis, consumers will move to that. In California, they're going to move to hydrogen. Consumers are doing what they do best. When you tell them things are high priced, they make a structural change, and this one I think is permanent.
That's your shock. Microeconomics with Philip K. Verleger. Would you buy the oil companies here, Phil, or are they done?
Well, it depends. The producers are done. What's happening if you look at companies like Valero that are focusing on producing products and squeezing the producers are probably going to do pretty well. I was on the Valero board many, many years ago, and I don't have anything to do with them now, but they're working really hard to make lots of diesel. They send it to South America. They send it to Europe where they need it, and they understand this business, and they're operating at a place where they have low crude costs. And Valero is going to be handed this gift of the Keystone Pipeline down from Canada, and I'm sure Valero and the other buyers, the major refiners down on the Gulf Coast that aren't connected to producers, Conoco soon and Marathon, will squeeze producers. So essentially, Keystone Pipeline is almost going to become the Judas goat. It's going to lead crude prices and domestic producers down. If you buy Exxon, the integrated, really big, successful integrated companies like Exxon will do fine. But if you want an industry model for this is like what happened to the wireline telephone business back in the 80s. We just saw the Verizon strike, and the reason we had the Verizon strike was they're not making any money from wireline anymore. They're making it all from cell phones. Well, the same thing's happening in the energy business. People are moving away from gasoline and petroleum products to anything else.
Why is it?
So
let me ask
you don't want to buy crude producers.
Okay, Phil, that's fine, but let me ask the obvious question here. Why isn't oil and gas cheaper if we're seeing the demand destruction, you're seeing, bring up that chart again, if you would, Rex, that's of the gasoline demand destruction, not Marathon. Bring up the other one here. There it is. Verleger considers our demand destruction. There's a chart. We're using less oil. I get an email. Al from New Jersey emailed me the other day. Why isn't gasoline and oil cheaper?
Well, it's the biggest problem, Tom, is the problem we've talked about in the past. We need light sweet crude to make low sulfur diesel. This is why on the Atlantic coast and in much of the United States, there's a shortage of diesel, there's a shortage of refining capacity to make the products that the environmental regulations require us to deliver. So what happens is the product prices lead things up because refiners can't make enough. And yesterday, Sun said, I believe, I can't find the quote yet, it would take them $900 million to upgrade their refineries. And they said, thank you very much, they weren't going to do this. And you know, everybody looks at crude oil, but the fact of the matter is we're short of refining capacity in the United States to make low sulfur diesel, in Europe and around the world. So product prices are going to be high, and this is just going to accelerate this movement away from gasoline.
Fascinating. Let's come back, Phil. We're going to come back with Phil Verleger and continue. Phil, the cheapest stock in the universe is Marathon Oil. They split off. They got upstream and downstream. The upstream oil's like a 2 times, 3 times EBITDA. I don't know if you're picking stocks today. Why did Marathon split into 2 companies, and what does it signal about our appetite to go out and look for the new marginal barrel of oil?
Well, Tom, one, I try to stay off picking stocks. I'm terrible
I understand
at that. I'm an observer in the industry. What has happened is I think all the financial advisors have told the industry that what investors want is upstream assets. So sell off your refining business. Refining is a business where you have to put a lot of capital and there are lousy returns. That's why Conoco, I think, is going to sell off its refining business. And put your money on the upstream. In fact, the advisors have the message exactly wrong because there's so much crude out there, and we're finding so much more crude, and environmental regulations are getting tougher. So the real constraint is in the refining business, and one way or another, we are going to need major refiners that can upgrade heavy crudes. The only company that I know that's really putting a lot of money in that is Saudi Aramco, and they're building some very elaborate refineries in Saudi Arabia. But to make 100,000 barrels of diesel fuel, which is the fuel we really need, you have to invest $4 billion in your refinery. Valero's investing $2.5 billion. They're going to get a roughly 60,000 barrels a day more diesel. And what we need to invest, the numbers I've done, are something like $200 billion of investment in hydrocracking and upgrading over the next 5 to 6 years. I don't think that investment's going to come. And so we're going to be short diesel, so everybody's going to be emailing you about high diesel prices, high gasoline prices, and there's going to be a glut of crude. But the thing is that the analysts who are following companies and thinking about the industry are just way behind the curve.
Right.
And where the market is right now is consumers are cutting down on gasoline. We need more diesel. It's hard to convert to diesel, so we're operating in a constrained situation.
Well,
it's,
we're going to have to,
everybody want.
We're going to have to leave it there,
Phil
Verleger. I'm sorry to interrupt, but terrific insight there about everybody going upstream, and Verleger, as usual, goes the other way.